It has been a rough 3 months for the major averages. The S&P 500 and Dow snapping three-quarter win streaks. The NASDAQ snapping a two-quarter win streak. Joining us now is Joe Moglia, former TD Ameritrade CEO and current Coastal Carolina University executive advisor. Joe, so this hasn't been an even market by any stretch. Mega caps have been doing better, but what does that mean? Like, for investors who are thinking about what to do here, does that necessarily mean that if there's a drop, that the other stocks that aren't mega caps will drop less? Might they drop more?
I think, John, if there's a drop, first of all, if there's a drop, I think the mega caps are really going to get hit, but so is everything else in the market if there's a real one. I think what's really taken place here is that with all the tightening the Fed has already done, there's a lagging impact in terms of what's supposed to take place in the economy and therefore the markets. So I think what we're seeing, I think what we're starting to see is an effect or the impact that the Fed tightening that they've been doing all along is starting to have in the economy now. Now, we're at 3.5% or so. To get to 2%, that's not that easy. It's a lot easier to get to 3.5% than it is to get to 2% from 3.5%. And that doesn't necessarily bode well for the market going forward. If the Fed just relaxes and pauses, I think we should be okay.
So the flip side of that is that yields are pretty high. And so what does that mean for what investors should do in their portfolios? You have some thoughts specifically when it comes to T-bills, right?
Right. Well, in general, I think, I think a lot of times when we talk about the individual investor, we talk about the risk profile and how old are they, and all that stuff matters. I get that. But for a long time, there's always been a big question in the market, like, what are you supposed to do? Is going up, going down, et cetera. Right now, though, and I've been saying this for the last few months, I think the perfect strategy that I would aggressively recommend to any individual investor is a very, very simple barbell. Take 50% of your cash, put it on one end. You're going to get 5.5% by being on one-year bills or shorter. And put the other 50% in some form of equities. If the markets wind up going up, you're going to get the benefit from the equity piece plus 5.5%. The market goes down, you only have half your money in cash. You're not going to get as bad as you would. Plus, you're going to get 5.5% guaranteed over here. If the markets really were to continue to drop, well, then you can always adjust that and go from 50% to a 60-40 number, et cetera. But there is no doubt in my mind that right now, every individual investor, or most of them on the planet, should be doing something like that.
Yeah, I mean, I think it's very telling to your point, Joe, when David Tepper speaks to Scott Wapner on CNBC and says that his latest investment is locking in at 6% on the 6-month certificate of deposit. To your point, I guess the question is this a window? Is this a finite window for yields to be this high, or do you think we go higher from here?
I think the fact, let's go back to we're at 3.5%. Okay, if we're going to get to 2%, and that's not going to be that easy. It's kind of like a diet, right? Neither one of you ever go on a diet, I'm sure. I'm on a diet all the time. If I got to lose 20 pounds, the first 5 pounds is pretty easy. The last 5 pounds is tough. This 3.5% to 2% is not going to be easy. So if at some point the Fed needs to tighten a bit, that's not going to be positive as far as the market goes, but it should help yields go up. So I think right now, there's no reason to me, plus I think there's a lot of supply coming in the fixed income market. There's no reason why fixed income yields are going to continue to go up, which reinforces, Morgan, I think the benefit of a barbell strategy.